Picture this. It's 2026. You pull into a gas station, but the price on the pump isn't just high, it's listed in 3 different currencies, and the US dollar is the weakest option. Your phone buzzes. It's not a social media notification, but an alert from the Treasury announcing an emergency halt on bond trading. This isn't a scene out of a dystopian movie. It's a potential glimpse into a world after the petrodollar. For 50 years, a series of quiet arrangements has helped keep America at the top of the financial food chain. But the final chapter of that era is being written right now. The global financial system is being rewired, and the only thing standing between your savings and a potential tidal wave of instability is understanding what's happening behind the curtain. This isn't about a sudden crash, but a slow, methodical erosion of power that is now picking up speed. By the end of this video, you'll understand the forces taking apart this 50-year-old system and, more importantly, have a clear roadmap for what it means for your money. To understand where we're going, you first have to know how we got here. Our story starts not in 2026, but in 1971. President Richard Nixon went on television and did something that shook the world. He severed the US dollar's last link to gold. Before this Nixon shock, the dollar was like a claim check for a specific amount of gold held by the US government. Afterward, that check was backed by one thing and one thing only: the full faith and credit of the United States. This sparked a crisis of confidence. If the dollar wasn't backed by gold, what made it valuable? Why would any other country want to hold it? The answer came not from a bank, but from the desert. In the years that followed, through a series of crucial economic and security arrangements around 1974, the U.S. forged a new foundation for the dollar. It was an elegant, almost deceptively simple understanding with the Kingdom of Saudi Arabia, the anchor of OPEC, and one of the world's most influential oil producers. Here was the core of the deal. Saudi Arabia, and by extension the rest of OPEC, would price its oil exports only in US dollars. Because every developing country needed oil, they would first have to get their hands on US dollars to buy it. This masterstroke created a constant, artificial demand for the dollar across the globe. But there was a second, equally critical part of this arrangement, often called petrodollar recycling. What would Saudi Arabia and other oil-producing nations do with the mountains of dollars they were earning? They would recycle them back into the United States, primarily by buying US Treasury bonds. Think of it this way. You buy oil from your neighbor using special neighbor dollars you can only get from him. Then your neighbor takes those exact same dollars and lends them back to you so you can finance your lifestyle. This created a reliable stream of foreign buyers for US debt. It meant the US could run massive deficits to fund its government and military, knowing there would always be a line of nations ready to lend it the money. This in turn helped keep US interest rates lower than they would have been otherwise. For decades, this system worked almost perfectly for the United States, cementing its status as the world's financial superpower. It wasn't a single secret treaty, but a series of well-documented understandings that shaped the global economy. The dollar wasn't just America's currency, it became the world's. But no system lasts forever, and the cracks were already starting to show. The first real tremors were felt not in Washington or Riyadh, but in Baghdad. In the year 2000, Iraqi leader Saddam Hussein announced he would sell his country's oil in euros, not dollars. Now, while mainstream history points to WMD claims and regional politics as the cause for the 2003 invasion, a powerful counter-narrative emerged in some circles, that this was punishment for daring to challenge the dollar's supremacy. A few years later, a similar story played out with Libya's Muammar Gaddafi. He was sitting on a mountain of gold, around 144 tons, and was openly discussing a gold-backed Pan-African dinar to be used for oil trade. Again, while the official reason for the 2011 NATO intervention was the protection of civilians during a civil war, the petrodollar retaliation theory remains a potent, though highly contested, interpretation of events. Whether you see these events as direct retaliation or just geopolitical coincidence, they send a chilling message. But while many focused on these individual challengers, the tectonic plates were shifting under the entire system. The true earthquake hit in 2022. Following the conflict in Ukraine, the United States and its allies made a move that, while not entirely new, was unprecedented in its scale and target. They froze roughly $300 billion of Russia's central bank foreign currency reserves. This sent a shockwave through every central bank on the planet. For decades, reserves held in dollars or euros were seen as untouchable. Suddenly, that assumption was shattered. The message was loud and clear. Your dollar reserves are only yours as long as you remain in the West's good graces. Access to the dollar system had been fully weaponized. For countries in the global South, and especially for a rising power like China, this was a terrifying moment of clarity. Their vast holdings of US dollars weren't just assets. They were a potential vulnerability. The search for a financial system outside of Washington's control was no longer a theoretical exercise. It had become a national security emergency. We're about to dive into the 2026 prediction and what it means for your money. If you're finding this analysis valuable, do me a favor and hit that subscribe button. We go deep on the hidden economic and geopolitical forces that the mainstream media often ignores, and you won't want to miss what's coming next. Welcome to the Great Unraveling. What started as cracks is now turning into a systematic dismantling. This isn't a collapse in a single day, but a slow, deliberate move away from a system of coercion to a system of choice. And the nations leading this charge are the BRICS countries: Brazil, Russia, India, China, South Africa, and their new partners. For years, the idea of BRICS challenging the dollar was dismissed, but the 2022 sanctions lit a fire under their efforts. The evidence of this shift is now impossible to ignore. First, just look at how they trade. Commerce between Russia and China has rapidly de-dollarized, with some reports suggesting that for many categories of trade, over 90% is now settled in their own currencies, the ruble and the yuan. Trade between India and Russia is also increasingly happening outside the dollar system. This isn't just about Russia, it's a much wider trend. Second, they are building the plumbing for a new financial world. You're hearing more talk about concepts like BRICS Pay. While it's not a fully mature platform yet, the ambition is clear: to link the national payment systems of member countries, allowing for seamless trade in local currencies and bypassing the dollar and the SWIFT messaging system. This isn't just talk. Bilateral linkages are already active and expanding. Third, and perhaps most critically, Saudi Arabia is making a strategic pivot. While there was no single petrodollar pact with an expiration date, the series of informal understandings that form the system are being reevaluated. Saudi Arabia was invited to join the BRICS bloc, and while its final membership status remains a subject of official clarification, the kingdom's leaders have openly stated they are exploring selling oil and other currencies. This is monumental. The country that was once the linchpin of the petrodollar is now actively seeking optionality, the freedom to choose its economic partners and the currency it trades in. And the world's central banks are voting with their wallets. Since the 2022 sanctions, they have been buying gold at a historic, almost frantic pace, adding over 1,000 tons in both 2022 and 2023. This exceptionally strong buying continued into the following years. Countries like Poland, China, and Kazakhstan are leading the charge. Why? Because gold is neutral. It's a reserve asset that no single country can print, sanction, or freeze. The message is clear. Central banks are diversifying away from the US dollar, not as a speculative bet, but as a long-term strategic necessity. This is not an overnight collapse. The dollar is still dominant, but the trend is undeniable and it's accelerating. We are moving from a unipolar, dollar-centric world to a multipolar, multi-currency world. And that brings us to 2026. So, what does all of this mean for you, your investments, and your savings by 2026? The last stand of the petrodollar isn't one single event, but a transition to a new financial regime. The risk isn't a sudden dollar implosion, but a period of intense volatility and a repricing of major assets. Here is the roadmap. First, gold. Gold is the most direct beneficiary of this global shift. Central banks aren't buying it for speculation. They're buying it as insurance against geopolitical risk and the weaponization of finance. For decades, gold was seen mainly as an inflation hedge. Now it is a direct hedge against de-dollarization itself. It's no wonder some bullish analysts have floated forecasts in the $5,000 to $6,000 range for 2026, citing relentless central bank demand as a primary driver. Second, the US dollar. The dollar isn't going to zero. Its deep, liquid markets mean it will remain a major world currency for years to come. However, its exorbitant privilege is fading. The erosion of its share of global reserves, which has already fallen from over 70% in the early 2000s to the high 50s today, will likely continue. For you, this means the end of assuming straight-line dollar strength. Expect much choppier, more volatile conditions in currency markets. Third, U.S. Treasuries. For 50 years, the petrodollar system helped ensure a reliable stream of foreign buyers for U.S. debt. That era is ending, as central banks diversify into gold and nations settle trade in their own currencies. There is simply less automatic demand for U.S. bonds. While U.S. Treasuries remain the global benchmark for a risk-free asset in terms of credit, a new factor has entered the equation for some nations: geopolitical risk. This doesn't guarantee a bond market collapse, but it strongly suggests the U.S. will have to offer higher interest rates to attract buyers, which has huge implications for the cost of mortgages, car loans, and the national debt. Finally, oil. The oil market itself is fragmenting. We're seeing the emergence of a two-tiered system: the official market, still largely priced in dollars, and a growing parallel market where countries and their trading partners settle deals in yuan, rupees, and other currencies. While this parallel market is still small compared to the whole, its very existence chips away at the dollar's dominance in energy, the very foundation of the petrodollar system. The world we've known for the past 50 years is changing. The petrodollar system, the financial architecture that guaranteed a global demand for US dollars and helped finance America's deficits, isn't collapsing in a day, but it is eroding. We are transitioning from a world of dollar exclusivity to one of monetary choice. This shift is driven by the weaponization of finance, the rise of competing powers like the BRICS nations, and a deep-seated desire by countries across the globe for more financial independence. This isn't just some abstract story for economists. The end of this system will impact the value of your currency, the interest rates you pay, and the safety of your investments. Preparing for this new era means understanding the role of neutral assets like gold, recognizing the growing volatility of the dollar, and acknowledging the new risks baked into government debt. The last stand of the petrodollar is happening now, not on a battlefield, but on the balance sheets of central banks, in the contracts of commodity traders, and in the quiet construction of new financial pipelines that will define the 21st century economy. The change happens slowly and then all at once. The question you should be asking yourself is, will you be prepared? What do you think? Is the petrodollar system here to stay, or are we really on the verge of a major global shift? Let me know your thoughts in the comments below.